Hey guys, we're with Kashop talking macro today. So all that macro. So I'm having a real hard time figuring out a name for this one. I'm not sure why. I just can't figure out a name for the show, and we've been doing this one for a long time. So if anybody wants to write in, tell me some great names that you guys have in mind for this show, please do. But I'm just drawing a complete blank. All that macro. I was trying to just think of things, and all I could think of is like an old show that was on TV when I was a kid, and I was like, "All that macro, great." It's a terrible name, so please write in. Please let me know a better name for this one. But so yeah, so looking at the market yesterday, I think it's interesting. We'll just kind of go over the futures right now, just looking at performance. I always like to go over the 1 month performance. Some people like to talk about day to day. I don't really care about the moves in a day to day time frame. I really care less about the 1 month. I really care about the year. I'm trying to make money every year, not every day. Um, so coffee up 9% in the last month, almost 10% in the last month. Soybean oil right behind that, up 7%. That gave some back recently. Had a nice little bounce yesterday, kind of sustaining that level at 47 right now. So we'll see where that one ends up. Um, Palladium, 6%. Had a big bounce. Once again, same kind of thing, just chopping around again. Oil, though, has really been resilient. Each pullback seems to be getting bought up. That's a really good thing to see if you're a oil bull. But what's very interesting is that the oil is outperforming the energy sector extremely right now. The energy sector is extremely flat over the last month, and oil is just bouncing like crazy. Um, so if we look at oil on a year to date basis, we're also seeing that oil's up almost 20% year to date. That's really good. But Japan behind it with this incredible weak yen, it's kind of funny to see. It's gone up a ton in because I only trade the NKD, which is the American denominated um, Japan futures. So that's actually gone up the same amount. So it's not just because of the yen, but I'm not exactly sure why the trend in Japan. Personally, if I was an investor long term holding something for 30 years, I would not want to own Japan. But as a trader, I will own it because it's an uptrend. And then if we go back to the 1 month performance, Japan is also up 6% on 1 month performance. Orange juice up 5%, gave some back recently as well, but also just still looking good. The Russell's up almost 5% in the last month. That's pretty interesting, and that's something we can talk about a bit more hopping into that. So Sam Gatlin sent me this chart yesterday, and I thought this was pretty cool. So shout out to Sam, always putting out really good stuff. If you guys saw the commodity report earlier this week from Monday, you can find all those on our YouTube channel. I know everybody's on Twitter on here, but please go to our YouTube channel, subscribe. Things like that keep us moving. It's hard to keep all this content coming out constantly, so please support the channel, support our Substack, support our newsletters. It all helps. But looking at this, Sam put this out, and this is the 1 day rate of change. It's something Sam and I were talking about, which was the ingredients in a big move in the market. And when we're looking at ingredients in a big move in the market, we want to see things like this, a big 1 day rate of change. This also happened, if you look back at 2020 after the election, this same move happened where you started to see IWM be the outperformer again, meaning the small caps are the outperformer. Once again, this is a poorly constructed ETF. I'm not saying it's the best thing to measure small caps of all time. I'm just saying it's a way of measuring it. So we saw the same type of move back then in 2020, where we saw the small caps outperform into 2021. This could be a great swing trade, position trade in the small cap space, just starting out right now. We're not 100% sure, right? It's not something we can say 100%. I would like to see some follow through, but these huge 1 day rate of changes are something that I've seen time and time again. So I'd like to see that sustain in the small cap space. One thing I found interesting yesterday, though, Kashop, was the fact that copper went down, but it gained it all back this morning. So it's up almost 2% today. copper coming down, while energy's moving was moving up. Crude oil had an update yesterday. Everything kind of reversed higher, but copper kind of came down a little bit, which I found kind of interesting. But I always think of news flows in this way: when you have one big day and a big move, I don't think the market gets everything right in one day when it's something news related. I think the market takes some time to kind of figure out what exactly it's thinking, what exactly it wants to do, what participants are really believing in the market. So I think that this one day move yesterday wasn't exactly spot on, even though I think it was pretty interesting. I think it said breadth is widening out. Um, I don't know if it's saying that the market's gonna, change into this small cap driven growth based area, or sorry, small cap driven value based area. But I do think we're also headed into an area where it's the breadth is widening out. We're going to see some of these lagging sectors start to catch up. So what are you seeing out there, Kashop, in this space, and what are you thinking about this chart, or just generally tech against small caps?
So I'm going back to what you pointed out about Japan. So the Nikkei futures and denominated in USD. So you have to. I think Japan is something that should be on every investor's radar because of the way it affects pretty much every market. So the saying used to be that when the US sneezes, the world catches a cold. And with the size of the yen carry trade that has gone on over the past 10 years, I think when Japan sneezes, the world catches a cold. So it's going back to your point on why the Nikkei futures are doing so well. So the Bank of Japan, I think it's the only central bank in the world which has a policy of buying Japanese stocks.
Mhm.
So I think they started that sometime around 2014, and they've got a pretty big chunk of all the ETFs in the market. In fact, the market was so illiquid that they said we will not interfere from now on. So when you have this relentless bid, so uh, investors, especially the gold bugs, they used to talk about this thing called the Greenspan put, then the Bernanke put, then the Yellen put, which is basically whenever the market kind of starts to waver, they said that the Fed would come in and rescue the market. So with Japan, that Greenspan put or the Yellen put or the Fed put was an actual policy which went on for nearly 10 years. So now you have a market which has a price insensitive bidder, and you have a market where there is pretty much no volume because the Bank of Japan takes most of the volume. So what is there for a trader to do? So you have had these macro theses where all these prominent fund managers over the last 10 years or 50 years, they would come and say, oh, Japan is cheap, let's go buy Japanese stocks. And then Japan would just do nothing, and they would just sit in those positions. They would neither make money nor lose money, and that just happened for close to a decade now. After a period like this, when you see the index outperform for a while, it just makes sense because you have all of a sudden you have this attention on a sector that has gone nowhere for a long time, and then people just chase it, and eventually the interest wanes and it falls back. And this is also something we saw with the Chinese stocks in 2014. So Chinese stocks haven't had a bull market since 2007, and then all of a sudden everyone wanted to buy Chinese tech. You had this huge blow off move in the Shanghai SH comp, and then it just petered out. And for 10 years, again, Chinese stocks have gone nowhere. Now, coming back to Japan, the reason it's important is because of the yen. Now, everyone has shot the yen because they have seen the Bank of Japan say that twice they will hold the 160 level and twice they have failed. So the market is just taunting the Bank of Japan. But at the same time, if you have taken a loan in the yen and you see this kind of thing happening, you would want to de-risk, which means if you are a Japanese investor and you have invested overseas, you would want to bring some of your capital back before the currency starts to appreciate. So, and the currency is at a 35-year low, so maybe it's a good time to bring some money back home, especially because the population is getting older. So, when you bring money back home, what do? You really don't have many options. Tokyo real estate is expensive, and the Bank of Japan has yield curve control, so you can't really buy the bonds. So what do you buy? You buy the equities. Now the equities have been cheap for so long, and even if it goes nowhere, you're still fine. So I think that's been what's happening. And the reason I think this matters to US investors is because the Bank of Japan and the yen carry trade, they have pretty much funded all the asset bubbles everywhere in the world. And that is true when it comes to infrastructure investments, that is true when it comes to straight up equity investments or funding startups. So, pretty much all of Chinese tech, Indian tech, US tech, it's all being funded by SoftBank and these other PE firms, which are all based on Japanese capital. I mean, yeah, you have Silicon Valley and Japan. So, you have this big move in the dollar yen. It's going to affect the valuations, it's going to affect the way they think about their investments, because these private equity firms, they're making 10, 20-year time horizon investments, and when you see a move in the currency, they have to plan for it. And the way, if you're leveraged and if you are planning for a move, the first thing you would do is cut down your risk. Now, if all these leveraged investors start cutting down their risk, that means that we are going to have some kind of deflationary shock, some kind of deflationary event. And I think that's pretty much what happened yesterday. So, yesterday you had the CPI, and at the same time, you had the Bank of Japan coming and intervening in the market. And you had all these firms which were caught offsides in their positioning versus the NASDAQ, and you had a nasty sell off. So it all came together and created some kind of shock. Now, if you look at what's happening in the market today, it's like market has pretty much shrugged off yesterday's event. But here's the thing: if something of the sort starts to happen over and over and over again, then someone's going to get the message and deliver. And unless the Fed's printing or liquidity is coming in through other ways, that deleveraging is going to see the big indices go lower. At the same time as those big indices are going lower, so Nvidia is what, 3.2 trillion, 3.5 trillion. Maybe Nvidia loses, say, 10 or 15%, and you'll have the XLE up 20% because of that, just because of the size of Nvidia versus the energy sector. So when you see moves like this, you can see small caps go straight up, and that's because, well, so far no one's been interested in the small caps. They haven't made money for a long time, and it's the same case as with the NKD, the Nikkei dollar futures. It just goes up because the trade hasn't worked for so long, and that's really all you need. You don't really need a big bull case. You don't need Stan Druckenmiller coming and saying this is the trade of the century. You don't need a narrative like AI. Nothing. It's like we saw Chinese stocks catch a bid. Why did they catch a bid? Because they banned naked short selling or whatever was the narrative. But it wasn't that which mattered. It was just that these stocks were so cheap, so neglected for so long. It just took that little bit of an inflow of capital, a little bit of liquidity flowing to those companies, and those stocks just shot up. So if you look at Baidu, like everyone looks at all the US tech companies, but if you look at a chart of Baidu, it's like just going straight up, is like not even correcting. And you don't get these kind of moves when in normal markets. You get these kind of moves when you have some kind of dislocation and there is some kind of liquidity flow that's happening. And I think that's really what's happening today. So when people talk about the Russell and small caps outperforming, sure, the Russell is important, and you had this big Russell rebalance last month. So what they did is, so just like the S&P, the Russell is also relative strength weighted. So what happens is they kick the weakest companies out, add the strong companies, and now the reason the Russell underperforms the S&P over the long term is structural. So when a stock gets big enough, it migrates into one of the other ETFs, one of the other indices, and it gets out of the Russell. Whereas with the S&P, you can have, I mean, if tomorrow Nvidia becomes a $10 trillion company, the S&P could be just 50% Nvidia and 30% Apple, and they wouldn't care. They wouldn't rebalance and just let it ride. So that's difference in strategy is why you see the Russell in the long term it underperforms because it's the gains are capped. But in the short term, you can absolutely see moves like this. But If you go beyond the Russell, I think you're going to see these moves in the small cap space. So yesterday was one of the best days for me in terms of my portfolio, and that's not because I was short a ton of tech stocks which went down. It was just because I was long a lot of small caps which started going up, and they started going up by a huge amount. And that's just what happens when you have this insane liquidity flow going from every other sector into something like Nvidia or Bitcoin, and then just some of it starting to reverse. Like Bitcoin is a $1 trillion asset. And what happens if 10% of that market cap rotates into the smaller cap cryptos? You see huge moves there. It doesn't mean that Bitcoin has to go down 10%. That doesn't mean Bitcoin has to go down 20%. You just can get this kind of rotation where the capital goes out of one massive asset into all the other smaller assets, and then you see these huge gains. And I think overall, investors, when they are looking at these indices, they should just keep it in mind that this is the time to be an active stock picker. If you're just looking at the difference between the performance of the NASDAQ and the Russell, or looking at XLE, or looking at any of the other ETFs, sure, you are going to catch this rotation. But if you dig a little deeper, or even if you are within the ETF space, for instance, instead of the XLF, if you are looking at KRE, instead of CQQQ, you are looking at KWeb, which is the internet stocks alone. So if you just go a little deeper than the broad spider indices, I think you're going to really have a good opportunity to outperform. And during the summer, we usually don't get these kind of opportunities. So it's really nice to see this happening, especially because I'm an active stock picker. So this is kind of my playground.
No, I mean that makes sense. It's when you see this happen, I think that's a problem with people always think about it as one thing has to be different than the other. And it's okay, let's go back to November during the election. You had the election happen, and people go, look, small caps, energy, these areas started to outperform again. That's great. However, tech still kind of went up. So it's not that we're just looking at it and going, okay, well, this is big, like you said, again, Bitcoin against the smaller cryptos. It doesn't mean Bitcoin has to crash. It just means that maybe it's going to be more stable and these other areas are going to outperform. So I think it's the same thing, like you said, where it's let's start to look at these other areas. We just got our first signal for KRE and God knows how long. Like I can't imagine when the last time I bought that thing. It's been a while. So the KRE gave its first signal in years. That's something that's also to me very personal to my models, where my price action models, the KRE is such a leader both directions. When you see like you're in a bull market and everything's kind of going up, not this very thin bull market that we're seeing today where there's only a few stocks and tech's holding everything up. The bull markets that we usually see where there's some breadth. When the KRE starts to turn down, you'll notice that other things start to turn down with it. And it's the same thing when the KRE starts to move up. You'll notice breadth should start widening out. You'll notice the next thing that we can talk about, which is a good call on your end, which was the conversation about rate cuts. We talked about this a while ago, and I was kind of going, I don't know if we're going to see him anytime soon. And you were like, well, we might see him this year. And that's something that I think was a great call, and it had me look at it in a different way and go, well, there is the possibility, and the reasons you gave at that time were perfect. We started to then get signals in the 2-year. We're also long the 2-year as well. So being long the short end of the curve, seeing where that's going to end up is going to be an interesting one. And seeing the Fed rate probabilities completely shift yesterday. There were so many people. I just had someone on, we were talking about it, and the plan for him was the probabilities for September were going to just continue to drop. And then yesterday, the probabilities went up. I think the last time I looked, it was 80-something% now. So there's a complete shift there to rate cuts coming in September. So, what are you thinking about that? Talk about your trade. How's the trade been going, and so on.
So I had a big rates trade on in April. So I was long the 2 year. I think I was long the 5 year or the 10 year, forget which. And then I was long the KRE as well. And the trade took a while to work out. So I cut the other bets and just kept the 2 year because the 2 year is the most obvious of the three. And that's been going well. And I added the Swiss franc because you brought it to my attention, saw that it completely reversed from a downtrend to an uptrend. And the way it's related to rates is that the USD has been strong because everyone expects the Fed to cut last. Once the Fed starts cutting, the dollar becomes the carry currency and the dollar starts to weaken. So yes, you're starting to see these moves in the so if you look at go back to October 2022 on the DXY, that was kind of the top. And the reason for that, like a lot of people would say that's because the dollar is considered a safe haven, and when people are scared, they move to the dollar. Sure, that's one part of it. The other part of it is that was when liquidity was the tightest. And that was just because of the sheer amount of deleveraging that was going on with the banking system. So we saw three banks or four banks implode in March 2023, but the move started even before that when they lost a lot of money on their bond portfolios. So when money was the tightest and the dollar just wasn't funding everything everywhere in the world like it usually is, that's when you saw the dollar peak out. And then when funding conditions ease, it has, I mean, it might be related to the stock market, but the stock market is not really all that important when it comes to global liquidity flows. It's the currency market, it's the bond market. So at that point, when dollar liquidity started to ease, you saw the other currencies kind of stop tanking, but not really outperforming either. And now I think with the rate cuts so nearby, you're going to start to see the strong currencies take off first, which is the Swiss franc, which may be the euro, which may be the pound, which may be the Canadian dollar or the Aussie dollar. So with the Swiss franc, you don't have any of the problems associated with the other currencies. So I bought the Swiss franc and I'm long the 2 year. And so here's the other part of this trade. So when I bought the 2 year, I thought maybe the Fed is going to cut right away. But my thesis for buying that, I also said, let's say I'm wrong about this. What could go wrong? And we saw that the COT report showed that sentiment was so skewed that there was like this record net short position in bonds. And these are deliverable contracts, meaning if you are short, you actually have to come up with a bond that you have to sell. So it's not like it's cash settled wherein you just adjust the difference in your margin balances and you just go about your way. So these contracts are actually settled with physical bonds or electronic bonds, however you want to put it. But so when you have this kind of skew, what happens is you kind of play the player. You don't just play the table, but you play the player. And that's when it hit me that this is a good trade to be in because it's a high probability setup with very minimal downside. And if you looked at bond volatility like ATRs, Bollinger Bands, whatever you use, there really wasn't that much downside. It was very easy to set a stop level. Now, after yesterday's move, I think it makes sense to start looking at going a little longer in the curve, mainly because people have started to price in rate cuts. Now, does that mean rate cuts happen? It absolutely does not mean 100% that rate cuts will happen, but all you need is that shift in expectations to make money. So, if you go back to October 2023, the Fed said they're going to ease financial conditions, and market went straight up for 2 whole weeks without a pause. It was just one up day after the other, and that is just because people's expectations changed. Now, when it comes to rate cuts, maybe it happens, maybe it doesn't, but after yesterday, people's expectations have definitely changed. So now, in April, the bet was on the 2 year, the bet was on the short end of the curve because that was the least risky bet to take. Now, with lot of people kind of realizing that bonds are maybe mispriced here, you can start to go ahead on the curve, meaning you can go from 2 year to 5 year to 10 year to maybe 20 year. And I mean, that's a higher level of risk. But the way the math works is these are the bonds that are more prone to capital appreciation. So if you are, so I think that's the other thing that I talked about on Twitter, wherein you had this long period of negative interest rates where people were buying stocks for the yield and bond for the capital appreciation. And I think the shift in rate cuts expectation, it's we are kind of going to start going back to that environment wherein people are going to start buying stocks for the dividend yield and start buying bonds because they expect capital appreciation. And why do they expect capital appreciation? Is just because financial conditions have been so tight and now they are starting to get a little looser. And so these bonds are going to get repriced. And I'm not just talking about US treasuries, I'm talking about corporate debt, I'm talking about preferred shares, the entire spectrum of credit. So all it takes is that shift in expectation and everything gets repriced. So I think that's where we are today. So for now, I am sticking to the 2 year. I'm looking at the KRE, but it's earnings season, and I really don't want to add too many rate cut trades to my portfolio, especially because I have gold, which is working wildly. I have the oil stocks, which is again working well. So I have a few bets on exploration stocks in pretty much every part of the commodity complex, which is nickel, copper, gold, silver. So I really don't want to add too much exposure to banks, but if my circumstances are different, I would absolutely be looking at adding KRE. And I would also be looking at adding biotechs because I think biotech again is it's all about the rates because fundamentals as such there is nothing for biotech. You have these companies which are making binary bets. You get something through an FDA trial, the stock goes up, the chance of you getting something commercialized go up, and if not, no. And for biotech, it's all in the funding environment when monetary policy is such that people are kind of not going too far ahead on the risk curve. People don't fund biotech stocks, they pull capital out, and then it reverses when financial conditions get easy. So I think the bet with biotech is simply the same as the bet with banks, which is that financial conditions are going to get easier. So there are a lot of ways to express that trade. So that's what I would be looking at.
No, I like that, and I think something to just also talk about is the idea which you mentioned, which is I have a lot of rate cut trades on, meaning when people look at markets and looking at a macro lens, which is what we talk about on here, means that all of our trades are connected in some form of way. For me, I always try to figure out what's my main thesis. What are my models telling me more than anything else? And my models will tell me, okay, rate cuts are coming up. Okay, inflation could get back out of control. Because that's the thing. Too many people think that those things are so different. You can't possibly have inflation moving up with them cutting rates, and it's like it's happened many times in history, actually. So that does happen, and so you get into these environments where you start to see, okay, the rate cut expectations are rising, and then oil starts to take off, and people go, well, why exactly is that happening? And the reason why that might happen is because, okay, people are looking at, if we do cut rates, if we do create liquidity, we will get to an area where we have inflation start to take off again. And then if you look at it and go, okay, well, in a rate cut environment where inflation might go up, I might also want to own things like gold and silver. Obviously, they're screaming that they're doing just fine, so you should probably buy them. And then you go into the stocks and you go, okay, KRE would benefit because banks borrow from the short end of the curve and lend from the long end of the curve. And so if the Fed rate finally comes down, we might not be in a yield curve inversion. So as a macro trader, like that's really what we do. We put those all together. We make an environment in our portfolios that benefit from this. So hey Steve.
Hey guys, happy Friday.
Hey, Steve.
Hey, how are you, man?
I'm good. What's new?
Markets, and I got this chart from one of your guys, Sam. So Sam sent me this yesterday, just as we were chatting. So what are you thinking about the market right now? That we were talking about rate cuts. We're talking about the rate cut expectations that changed yesterday. We're talking about small caps to large caps, small caps to tech.
It's what we've all been waiting for so long. It's going to be disguised and misinterpreted as bad for the market by some. If you look at the headlines from yesterday, worst day since April. Big tech sell, right? Mega caps collapse.
Yeah.
We had like 90-95% up day yesterday, depending on what universe you're looking at. Breath couldn't have been better. So we've been in this thin breath environment or narrow breath environment for most of the bull cycle, where if you're not in the Mag 7, if you're not in the mega caps, you're probably not outperforming. Think for 1 second, what does the inverse of that look like? Right? Because we've been in a world where most stocks are doing okay, not well. Majority of stocks are not even in primary uptrends. Yet SPY, Qs, right? These large cap weighted indexes they're up every single day because they're being driven by, the 10 largest, best stocks in the world. What if Apple, Microsoft, Google, Nvidia, and friends take a breather while the rest of the market maybe catches some flows from a little bit of profit taking in those early leaders? You're going to have sideways indexes, sideways S&P 500 or NASDAQ 100 or lower, like yesterday, worst day since April. However, it was the best day in terms of market breadth, components in the S&P 500 outperforming the S&P that we've seen in the past 25 years. So I think it's time to consider everything else outside of the ones that have worked. Sprinkle some love around.
Yeah, and then Kashop mentioned, buying individual stocks, and that's something that I think is an interesting take and probably the truth, because that's the thing. Everybody who I know who has a fund who's an individual stock picker has had a really rough time lately, because only you basically could only pick a few and be a winner, and now it's kind of seeming like that shift. And so seeing some of these smaller cap ETF areas, KRE having an insane day. IWM having a great day. And it's funny you brought up the headlines. I should probably try to dig one of those up for everybody. But there was headlines constantly everywhere, and that's what I was talking to. I think it was Ian about it yesterday. Yeah. And we were talking about it and going like, yeah, there's these constant fear mongering things out there right now that makes the market look terrible, when we're all sitting here going like, yay, the market's finally in a way that traders could actually benefit from it.
Yeah. It's always a stock picker's market, but if the trend or yesterday's theme plays out over sustained time frame, then it's really going to be a stock picker's market, right?
Yes, and I think that's what you need. It's what you need. You need breadth to tick up to be into all of these other areas. So you don't just have to buy the Mag 7. You're better off just buying the Qs at that point and sitting on your hands.
I also think it's important to take a step back. What's driving all of this, right? This is a interest rate sensitive rally of the last 3 days. I don't know if you have it. I could share screen and show it, but the 10-year yield had a very clear, well-defined uptrend line all year. Yields have been moving steadily higher this year while stocks have been doing well for most of the year, right? That's breaking now. That just broke. Powell came out and told everybody that it was probably going to happen earlier this week, and then CPI came out and confirmed the earlier data from Powell the other day. 10-year yield broke its year-to-date trend line. The US dollar now following, breaking its year-to-date trend line. I don't think these become massive intermarket tailwinds tomorrow, but you're seeing the way banks, real estate, biotechs, speculative growth, home builders have traded just with this little trend line break the past couple of days. If we head back to the lower bounds of the broader ranges in dollars and rates, that can only be a good thing for the broader market. And it's probably a market that looks a lot more like yesterday's than the whole first half of this year's, if rates and dollars are trending back to the lower end of their ranges.
Yeah, and just brought this chart up, and I brought it up in white for Steven.
Thank you.
White. He gets very upset. He hits me sometimes. It's okay. But, but now we got this chart out here, and you're right. This is a great chart. It's interesting because we were talking about it the other week, and with you actually, Steven, and I said, it's the first time we are neutral bonds in God knows how long. It's been a long time to be neutral bonds. Now we're finally neutral bonds again. We're actually getting buy signals today in the 10-year. First time in a very long time we're seeing any of those. So, the 2-year went long already, the 5-year went long, and now we're in the 10-year. The 30-year looks pretty similar too. An incoming signal could happen within the next week. We just have to basically clear 121. When we clear 121, we'll have a signal in bonds across the curve. That did happen once in 2020, the end of 2023, I think. 2022. That did happen in 2022 one time, but that was it. So, Kashop actually was the one to first talk to me about, hey, the 2-year, the bonds might actually shift. We might actually see some bottoms coming up. This is a month ago or so. We had a good conversation about it. Next thing you know, we're seeing the bonds finally start to take off. So great call on that. So, the other thing, and I've deleted this chart to make room 30 times, but let me try to find it again. But the other thing I was looking at, which was position, and this was the one thing that kind of happened the other day that was really interesting, which was the positioning in the Russell and the reversal that we saw in the Russell as well. So let me bring that up here.
Oh, so, yeah.
We're looking at that massive positioning shift, that happened. So you basically, that green line at the bottom, when you're looking at that green line, that's the commercial traders. Commercial traders are the technically the smart money, but they buy a lot of dips. And when those get to extremes, we get to see reversals happen. We saw that get to a major extreme on the low in 2022. And then that kind of carried where they kept basically buying every single dip in the Russell. And then we saw a huge bump in it. And the commercial traders started buying like crazy again. Yes, it did make a new high. However, the volume was extreme. And we saw that come in just a week ago. And now we're seeing this new move higher in the Russell. So I think, this looks very sustainable. I think the move in the market looks sustainable, whether we're looking at bonds, small caps, any of these sectors, gold, silver, gold miners look great. I mean, it's literally just very sustainable move. Breadth may be widening out. Once again, we can't know for sure. Summer's full of false rallies and false moves, but I would go with the price. I don't care what time of year it is. You got to go with the price.
Yep. You see that band squeeze in the small caps?
Yes, the band squeeze break. I posted about it. It was funny. Sam sent me it too, and I was like, I actually made that post about it pretty recently too, because you have these. We get the band squeeze signals like crazy, and that's the thing. Like I always have systems that are giving me every single band squeeze. I even get it in the stock market, and you'll see that the small cap area. Like if you go through all the small caps inside of IWM or IWC, which is I think the micro cap ETF, you'll start to see that there was band squeezes across the board in all of these different products. And I like
all year. Like volatility's been contracting literally since like December.
Yes, and so they start to chop down, and we get this huge move higher. It looks really sustainable. It looks really sustainable.
We always want what we like to call a decisive resolution out of patterns, right? And we get so many questions, great questions every time. What the hell does that mean? It means yesterday, the candle in IWM. Right, you're at this major polarity zone. Volatility is tighter than it's been since prior to the COVID, right before the COVID crash, right? So we don't know what direction that volatility expansion occurs in, right? Once that range finally resolves itself, but we do have underlying trends and intermarket information that we could lean against. Hey, if all the other ones are completing primary trend reversals, maybe small caps do too, right? If the trend coming in to this year-to-date consolidation, something like the Russell 2000 was up, then maybe the path out of this consolidation is also up, right? Because trends persist. So we had those kinds of things to anticipate this move. But yesterday we got it. Biggest day or best performance of the year from the Russell 2000. And it was confirmed by things like regional banks and biotechs, which an index like that really needs confirmation from. So I'm with you. That was the definition of a decisive breakout.
Yes, perfect. I mean, and that's the thing. I get a lot of questions. People always ask me about my grading the breakouts. I have grade A, grade B, grade C breakout.
Yep.
This is a grade A breakout. Especially like my favorite thing to do is if you're looking at ETFs, looking at the internals and the biggest names inside of it, and if you see they're also kind of confirming the same type of move, that's really telling you something.
Yep.
And so I have this chart. I was actually just going to grab Sam's chart because Sam's charts are prettier than mine.
Mine too.
Yeah, he's good. He's got good stuff. But just looking at it right here, I'm about to pull it up. But man, that was just a setup of a lifetime. Lowest volatility in small caps since 2021, which is what led to the decisive move down. That's the thing people don't talk about enough is, volatility works both ways. It's not going to tell you a direction until you get that breakout. It's the thing that people just don't do. They don't sit on their hands enough, wait for the breakout to move. Yes, the breakout move, you set a buy stop, it gets hit. Futures are great. We got hit overnight. Then you have a nice little move into the daytime. It's fantastic. But if you just still buy it, it's a gap out. Gaps, you should buy those. Everybody hates it. I think the craziest gap I ever bought, and everybody hated this one.
November of 2016.
2020.
It happened again, yeah.
There's two of them, but this was the energy one, where the energy sector after the election went up, what was that, 10 or 11% a day. And I ended up buying this gap, and everybody thought I was insane. Like, I got so many messages from people like, what is wrong with you? Why in the world would you buy the gap? It's going to crash. Gaps get filled, and it never, I don't think it ever filled that gap. It never looked back anywhere near that gap. It went up for years. It's still making new highs, actually. So, you have to buy these gaps, and you have to be willing to just go, okay, I'm just going to buy these gaps. Sorry, some of the lines aren't as pretty because this is a candlestick chart, but lines on here basically seeing, the quick breakout. I should make that white so everybody can see a little better, but that quick breakout, you can blow it up on your screen if you want, but volatility very tight, quick breakout. I think that's a good trade. We'll see where that goes, but yeah, going forward, man, what sectors from both of you guys are you guys looking at? There's all these different sectors that are moving right now. If we look at even copper miners are moving nicely. I looked at XME yesterday; it's moving nicely. All these weird things in our portfolio are moving nicely. So, what sectors are you guys thinking could really benefit from the moves of the market or the markets are making yesterday?
For me, it's Chinese tech. That's the latest sector in which I'm getting so many buy signals. So
Okay,
I bought Baidu and JD.com yesterday.
Love that.
Looks like the move is just beginning. I already had Tencent and quite a few of the Chinese stocks from earlier, but I think this sector could really run, and it makes sense. So you have this correction in US tech, and you have a rotation of tech money going from extremely overvalued. So you have stocks in the tech space which have a PE over 600, and then you go over to China. Sure, you have governance issues and all that, but the PE is less than 10, and they're trading at book value or 2x book, whereas US tech is at 30-40x book. So it's not hard to see this rotation happen. Like, you have all these tech funds that have been launched over the better part of 2 decades because tech has been working for that long. And what do? They're not going to give money back just because US tech enters a bear market. They're going to go find value or opportunities elsewhere. And what do you buy? You buy China because that's pretty much it. You could buy India, but they've already bought India, I think.
Well, no,
so
India has the same problem, Kashap, you're saying, right? Because that's probably
Yeah.
the better investment alternative rather than US tech stocks. To an emerging markets manager, it's India or China's tech stocks. And India's are just as expensive as ours.
Right. Yeah. So you have literally no choice but to go back to China or start buying Japan or any of these other so-called value space. I mean, earlier they used to go buy Russia, you had this big bank, I forgot, Spur Bank or something, which was like the big Silicon Valley bank. It was their Russian equivalent, and now you can't do that. So where does the capital go? There's just one place for it to go. So
Uh,
that's where I'm focused on.
I love that.
Yeah.
And I'm with you. So today, Sean and I are putting on January 2026 $20 strike calls in 10-cent music. That's TME. This has been the hands down best stock in China this whole cycle. This looks a lot more like a US Texas. Yeah. Throw up the China internet. Now throw up TME. So we've been leaning on this one. It's been working while none of its peers have. And we're just going back to the well. Give it 18 months. If this actually becomes a new bull market for China, who knows where this thing is, come January 2026. So that's our vehicle for today. But I love what you're saying.
No, I think in general, it's China's a place where I think there's still a lot of value. I think there's a lot of things to buy. I think there's a lot of things to be interested in. I just think that people have written it off in such a way that's ridiculous, and we're starting to see relative strength in it. And to me, when I start to see relative strength and everybody hates something, that's when I get really interested. Especially when I hate it. When I go, I wouldn't buy that. I try to, and I've told people this before, and they think I'm ridiculous when I'm saying this, but I say like sometimes I have to fade myself, and people go, "What the hell does that mean?" It's like, no, my own brain will tell me to do things just like anybody else. I have my own terrible ideas, but sometimes you just fade yourself and go, you know what? Maybe you're being a little bit too bearish here. Maybe you're getting signals, and you should just shut up and take your signals because that's why you build your systems. But TME, same thing, massive uptrend. Moving out of a nice squeeze, that's a weekly chart, so that it's squeezed a little bit more than that. So probably on the daily, you'd get a band squeeze. Probably the options were at a good price. So once again, I mean, there's all of these trades to do here. Even something simple like leaps on FXI. Something simple could be a very beneficial trade in the next year or so. I just think that this is. I think too many people are going, this market's long in the tooth. It's got to crash. There's a funny chart. Our friend, what's his name, Larry, posted the other day, which is about the. Somebody said new Dow theory, and they were showing like the difference between the Dow Jones or old Dow theory actually.
Yep.
The difference between the Dow Jones and the Nasdaq, and showing how far they were away from each other. Therefore, the market has to crash soon to get that back to the equilibrium. Even though Dow was never around.
Dow is making new cycle highs today.
Yeah. So I mean, so what he was pointing to, it was ridiculous, and the reason. And somebody asked me to explain this the other day, and the reason why it's ridiculous is because there was no Nasdaq when Charles Dow created Dow theory, and it was the Dow Jones Industrial against the transports, and that was all it was at the time, and that was the biggest component of him figuring out market direction, where the market could go based on those two things. Yes, we have new Dow theory. Yes, we have semiconductors possibly being like transports and so on. So there's new Dow theory, new ways of looking at it. But if you're talking about the original Dow theory, that's the reason why we all shared around that chart and laughed about it.
I like to believe that if Charlie Dow was here with us today, he would be doing the same exact thing, but with the semiconductor index.
I think it's. So there's a few different things. There's semiconductors are a great way to kind of understand the market direction. It's a risk on thing, very similar to biotechs, like we were talking about earlier. The semiconductors, yes, they have a little bit more reality, obviously, but biotechs are also another thing that there isn't a ton of fundamentals behind it. It's a lot of speculation. It can kind of tell you market direction. So I believe at the same time, it's like things have to change over time. I think he gave us the tools and the template of the transports, Dow, and so on. But now we have all these different sectors. So we have to take all these, like KRE, what's the regional banks telling us? What's the XLF telling us? What's semiconductors telling us? And so when you kind of go through all those and kind of put together a template of how you should trade the market and what the direction is going, I think that's the most powerful way to trade. I think people, if you're a technician and you're just using the charts, that's great. But if you can go through them all and figure out where relative strength is heading, and what type of market environment we're in, you're going to make a lot more money than the person just looking at the charts for chart's sake.
I totally agree, Jason. So Financials would be my answer. I think it's the cyclical stuff. I think it's the interest rate sensitive stuff that's been partying this week. So home builders, there's going to be parts of industrials. I think materials are finally going to have their time again. But the financials are leading that theme in a big way. XLF is already at new cycle highs today. The big banks look incredible. Maybe they're not so actionable here today. They all have earnings coming up, today, tomorrow, not tomorrow, but early next week. Most of the big banks come out and report. Maybe you don't want to buy right ahead of that. But this group looks so good. And it's not just the banks. The big banks will drive XLF to new highs like we're seeing this week, but it's capital markets, it's broker dealers, insurance is always good. The regional banks are joining with the big banks finally. So financials really have my attention.
I agree, and it's interesting to hear Kashop also talk about buying the KRE, because I don't know if I've ever heard you say that in all the years we've been friends. Because Kashop was talking about the KRE today too, and we're long the KRE. We got our first signal actually yesterday in a long time.
Oh yeah.
So it's a XLF has been along for us for maybe over a year now. But when you look at all of these things and we put the big macro picture together, it's just telling us, I think, a perfect point to kind of end this segment on, which is it's just kind of telling us the market's probably still in an uptrend. That small caps and breadth is wide. Small caps might lead the way, breadth might widen out. So I think that's a great place to kind of end it on. And Steve, you had something that we were kind of chatting about earlier. So what's your thoughts, Steve?
Yeah, speaking of failed tops, I'm going to go ahead and share my screen here.
Okay.
We do this thing, guys, where we track insider activity and try to follow the smart money into their trades, right? So there's a lot of this. Different data providers put it out, tracking things like Form 4s, 13Gs, 13Ds. We actually ignore the Fs. They're not really timely enough for us. But you want to know what the smart money is doing always, right? And corner examples. Here we go. Can you see me? Okay.
Yep, we got it.
So the whole idea of this data set for us is to build a universe of stocks that are seeing interest from insiders, right? So whether that is C-suite executives, corporate insiders, or large institutions who often become insiders by taking big stakes in companies, politicians. We also consider insiders, Washington insiders, Fed chairs, insiders. We're tracking all of these filings in different places. That's really how I started my career. I started my career in public reporting. So I was forced to become very familiar with things like the SEC Edgar database, right? And different filings. Worked on a lot of these SEC filings earlier in my career. Then I worked at various hedge funds for another several years where I was actually filing the filings instead of auditing them, right? So we have the expertise and we track these buys. We ignore the sells because there's all sorts of reasons why insiders might sell. And we got a really big one that just stands out so much. This happened earlier this week. It was announced 2 weeks ago, maybe, by the Hut 8 Corporation CEO. This is one of those Bitcoin miners. And what's been going on with the Bitcoin miners for the past, I guess, few months now is some of them have been absolutely ripping. Not all. Not Riot, Mara, CleanSpark, but ones like Hut or Wolf or Iris Energy, you're probably hearing a lot about. They're pivoting from Bitcoin mining to AI compute. And Coatue Management is, at least right now, it's early on, one of the leaders when it comes to AI investments. Early investor in ChatGPT and OpenAI. They own all the Mag 7s and the big cap tech names. But this is one of the premier technology, innovation, now AI investment companies on Wall Street. And they're coming out investing $150 million, taking a 10% stake in Hut 8 Corp, not because they are interested in the Bitcoin mining, but more because they're interested in the new AI compute business that some of these Bitcoin miners are pivoting to. So this is just such a perfect example of what we're looking for in these insider names. You have this primary trend reversal shown very clearly here with the green arc, right? Coming off a nasty bear market in 21, 22. Coatue management is taking a massive position right here, just as it looks as though the primary trend is reversing. So we skip all of this opportunity cost, right, over the past few years, while this thing's chopping around and consolidating. We see the insider come in. We'll get in maybe a couple dollars higher than him or them, Coatue, because we need price confirmation. We really want to see a valid base breakout take shape here, and then we'll follow them into their trade, right? And ride these trends with the smart money, with the big money, whatever you want to call it. So I just want to go back and show how this has worked throughout this cycle. Here's Uber. CEO Dara Khosrowshahi buys pretty sizable purchase, $5.3 million worth of stock in the first half of 2022. That's what the Uber chart looked like then. We want nothing to do with it. We're technicians. We're not trying to catch a falling knife. Uber's in a 60% drawdown from its 2021 high at this point. But a few months later, this looks a lot different. I've color-coded the 200-day moving average because it's one of the easiest measures of the primary trend, right? You could see it turning green right here. We put a long idea there where we could define our risk, and it looks like a primary trend reversal is underway. So we're happy to pay, in this case, $7 a share more than the CEO did, because we're missing all this opportunity cost that took place in between when we bought and when he initially bought. You look at something like Uber today, fantastic. MicroStrategy, same thing. Director and CTO were buying. Another director was buying. Massive insider purchases, early 2022. Chart looked terrible. We want nothing to do with it. As soon as we find a support level, looks like we have some evidence of a bottom, we can get involved. We actually got involved here on a little bear trap, failed breakdown, scoop and score situation. So we were in a couple dollars higher, actually a couple dollars lower than the insiders here. And the rest is history. Here's MicroStrategy today. Carvana is another one of our big winners this cycle. All sorts of insider buying in Carvana when everyone was convinced this stock was going to zero. It's literally a 99% drawdown. We're watching, we're monitoring, we're tag teaming that data with a back then 70% short interest, right? We spot our level, we look for a way to enter. We're into Carvana, I don't know, $1 higher than the insiders. That was back around $8. We're trading north of 100 today. So that's the idea here. We're taking that insider information. We're also tracking guys like this one was Bill Gates and Ecolab, right? But we're waiting for the trend or for price, just like any other indicator, to confirm that insider information. Then we hop onto these trends and we ride them higher with the insiders. I really think, Jason, it's one of the best things that we do. So I encourage you all to check it out. I do have a link here, which I just dropped in the private chat, I think, Jason, if you could share that with everybody.
Yep.
We're running a promotion right now. Talk to Mary. You can get a deal on this, but it's really, I think, the best thing that we do at All Star Charts. And this universe continues to be so good. And I'm excited about Hut and Twist and some of the other big insider buys we've had lately. This Archer Aviation is really on our radar with the Stellantis investment recently. So I think there's more great setups to come, like the MicroStrategies and Ubers and Carvanas. So get involved, click the link. That's my spiel, Jason. Thanks for letting me do that.
Of course. Yeah, so I posted it in the chat for everybody. It's on the screen. Also, I'm going to post it on Twitter. If anybody wants to just run to my page, feel free to just go to my page and share that. So, but yeah, I completely agree. I think the thing that's it's what I use on commodities, for the fund. I think the thing that's the most important is figuring out what's going on with the insiders, the people who actually understand things. But I also understand that these dislocations can happen for a long period of time. So like you said, taking these both, putting it together, hey, I'm going to figure out what the insiders are doing, but I'm also going to wait for the trend to change, price action to confirm it, and so on. And that's how you get your signals. It's a hell of a tool. So I think that's a cool one. Glad to see you guys doing that.
In commodities market, you're talking about commercial positioning. Those are your insiders. That data is really easy to track and super available, right? So like we do stuff around, What?
But it is not for stocks.
That's right. So like we do stuff around the COT report. We don't have our own like commercial position tracking simply because it's out there. We went to get this insider data. We tried all of the data vendors. None of them do it well. None of them do it correctly. You know, they're out here talking about Nancy Pelosi last week buying calls in Broadcom that are $1,000 in the money. Like those aren't the trades that we care about, right? That those are the tweets that blow up, and the masses love that kind of stuff. But we're really focused on what's important and the insider transactions that are significant and material and really stand out. So we have materiality filters. We also have just tricks that we've picked up over the years. Like sometimes you see a vote of confidence buy after a board meeting where like 4 or 5 different directors will buy like $20,000 worth of stock. That usually means the stock is going lower because it's like an unspoken rule. If you're on the board, you should use your stock comp, right? Or your board comp to buy back stock in the company when times are bad. Ask a board director. Like that's what they believe they're supposed to do. So your stock's in a 50% drawdown. You have a board meeting. You all say, hey guys, we got to go out and make an open market purchase, right? Try to put a floor in this situation here. And you see that all the time. We ignore those. So there's all of these different situations in commodities markets, futures markets, rather. It's really easy. We get that position reported to us from the CFTC. With this stuff, we got to dig through the SEC Edgar database. No one's like looking through these filings, right? After they're reported to the SEC. Nobody works there at the SEC. This is an agency that's been defunded as much as any. They can't track these things at all. So we know what to look for, what matters, what doesn't. We see incorrect filings. We see error filings all the time. So we said, forget it. We can't rely on any of the data vendors or any of the providers because they all try to automate it. We're literally looking through these filings with our own eyes, not using robots or trying to automate this every single morning. And then, using our discretion or our professional judgment to decide what's a material or significant insider purchase and what's not. So I'm really into it, as you can tell. I think it's the best thing that we do.
No, I love it, and I think it is important, and it's something that you have to kind of understand. So I guess the question is, and this could be to both of you guys, who's the person that you would pay attention to? If you're looking at insiders, and I feel like you've had this argument with JC before. I feel like I saw an argument with JC about you think one person's the most important and he thinks another person's the most important.
So it differs. So if I'm looking for a Form 4 buyer, it's a corporate insider usually. I want the CFO, the chief financial officer every time. The CEO knows what's going on, but he's high level. It's literally the CFO's job to know what the street expects from your earnings, to know if you're sandbagging earnings, to know if you're throwing in the kitchen sink that quarter, right? And to know where the market is at and how the market will react to that. A good CFO isn't just putting out an earnings report and being like, I hope they like it. No, he is acutely aware and in tune with what the market or what the street or what analysts are expecting. And he's trying to beat that, right? And he's not trying to beat it too much. Look at JP Morgan's earnings from today. They just marginally beat. They beat by a tiny bit on like every number. You think that's by accident? These guys are really good at this. The CFO is doing that, right? Oh, if we're going to beat too much on this one, no, take a loss here this quarter, right? And then we'll shift that, just a timing difference to the next quarter. We'll book that in the next quarter because we got a big beat here for this quarter. Right? These are little accounting tricks that are not illegal at all, but are easy to do, and that's what companies do. So the CFO is the one who's in tune with the market, how the market's going to move. We saw some major CFO buys at the bottom. Adobe was one that really stood out. Broadcom CFO came out buying stock. These guys are the best when it comes to the corporates. And then when it comes to the Form 13s, it's the institutions. Everybody likes to think, oh, you want to follow Paul Tudor Jones. I want to follow Stephen Cohen. He's going to be in and out before you even get that filing. It's not the right idea. You want to follow Warren Buffett or Carl Icahn. You want to follow Baker Bros into their biotech trades, right? Guys with great track records and long holding periods, not these long short equity funds. You don't get the information.
The way, for me, I get into a stock based on the fundamentals, but something that really interests me is so for instance, Agnico Eagle is a gold miner, and they just went out and bought a stake in a nickel asset. Now, when you see a move like that, I get very interested because a company like Agnico, I know their history. I know they would not go beyond gold. So when they go make a purchase in nickel, I'm automatically interested in that company. And the most unusual situation I faced was there was this company called Argonaut Gold. There is this company called Argonaut Gold. Like 3 or 4 years back, they gave a contractor a project to construct a mine. And the contractor took part of their compensation in Argonaut stock. And that is very, very unusual because a contractor has bills to pay. They are not in the business of equity speculation. And it just told me if they see this much value in the stock, then the stock is a buy. So you have the way I use these insider transactions is, or not the exact insider, the way you defined it with the SEC, but the way I looked at these transactions is when something this unusual happens, that has to be on my radar. And the other way I look at it is you have a company which mines in one specific part of the world, they go and acquire an asset in a different part of the world. And some of them just do it because they just blow up their share structure to get the higher ounces of production because they want a bigger weight in the index. But some of them do it because they see something so compelling that they just can't ignore it. And I've seen a lot of these happen in Argentina. And this was Argentina before Argentina became popular. And the reason is just that they take a longer term view. And I've seen companies do this in Chile in the 90s. So just go back and reading mining histories, you see that they did geophysics, they did surveys in the 90s. And you would think Chile in the 90s, really, but they had the plan and it worked out. So I get what you're saying. Like when you talk about all these insider buys which happened in 2022, and then you had that long chop, you had to be patient and wait for your entry. And it's the same way when I look at the fundamentals. I have to understand this data. I kind of have to have it somewhere in my mind. And then I have to just wait for the entry. And the entry may happen in a year, it may happen in 10 years, it may happen, or it may never happen.
Yep.
And I think that's exactly why retail loves Nancy Pelosi tracker and unusual ways and accounts like that, because those are straight away actionable. Whereas building a database, trying to make it more systematic, that's not very actionable in the short term.
You know, what we tend to see with the best insiders, and it makes sense. So if these guys have near perfect information, right, they do come out and try to catch falling knives long before the trend is up. They're buying nasty downtrends, but because they know all these things that we don't, right? So we'll let them do that. We'll let them take that risk. And then the way that markets typically work is there's like some sort of an accumulation phase. They're buying when there's blood in the streets, right? Down 20% on earnings one day. Then there's some, you know, whether it's months or quarters or weeks of accumulation, you get some sort of tradable low. Then we can get in and say, oh, that insider was right, you know? And then we get price to confirm that data, just like Jason was talking about with the volatility indicators. You know, a band squeeze is fantastic. Love it. We got to wait for price to confirm it. Insider stuff is no different. So I couldn't agree more. Love it.
So do you guys, when you see that breakout happen, is that when you guys put out the signals like, hey, we have this, you know, okay, cool. Yeah.
As soon as the evidence of a primary trend reversal is there, we're in. Cool. Like that day, we got our alerts set and the posts are pre-written. We got 2 posts right now that we're just waiting for a price trigger and we're close, but not there yet. And then green light, we go.
Nice. Very timely. So, all right, guys. So that was great. Great show today. Just want to thank Steve for coming on, Kashop. Both of their Twitter handles are on there. So we also posted, and I'll share this one more time, but we shared what Steve was talking about. So if you guys want to get the hot corner, you guys can come onto the website, talk to Mary. Mary can kind of get you guys connected. And then you guys can start to get access to that product. Very cool. Like it. I like it. It's good stuff.
Thanks, Jason.
All right, guys. We'll see you soon.
Bye, everyone.